Welcome back to Accounting Journal Entries. If you've ever felt confused about adjusting entries, you're not alone. But don't worry. In today's video, we'll break down what adjusting journal entries are, why they matter, and go over 5 key types you need to know with simple examples. Let's jump in. Adjusting journal entries are entries made at the end of an accounting period to update revenues and expenses that have not yet been recorded. This ensures that your financial statements are accurate and comply with the accrual basis of accounting. Accruals are crucial for financial reporting because they accurately reflect income and expenses, are mandated by GAAP, keep financial statements current, and prevent misrepresentation of profits. There are 5 major types of adjusting entries. Let's now examine each of these 5 types with examples to understand how they function. We'll begin by looking at prepaid expenses. Let's say you have a lemonade stand and you paid $600 up front for 6 months of rent. That's a prepaid expense. At the end of the first month, you need to recognize 1 month's worth as expense. You're recording the rent used during the period. The journal entry involves a debit to rent expense for $100 and a credit to prepaid rent for $100. This moves $100 from your prepaid rent asset account, because you've now used that portion of the rent, to your rent expense account to reflect the cost of rent incurred. Next, let's take a look at unearned revenue. Suppose a customer paid $120 for a bulk lemonade order to be delivered next month. You recorded unearned revenue when you got paid, but now it's month end and you delivered half the order. When you receive money for services you haven't performed yet, it's initially recorded as unearned revenue, which is a liability because you owe a service or product to the customer. Once you actually perform a portion of that service, in this case $60 worth, you've earned that much of the money. To reflect this, you make a journal entry. Debit unearned revenue, $60. This decreases the liability because you no longer owe that portion of the service. Credit service revenue, $60. This increases your revenue as you have now earned this amount by providing the service. In simpler terms, you're shifting $60 from a debt, unearned revenue, to actual income, service revenue, because you've fulfilled part of your obligation to the customer. Next, let's take a look at accrued expenses. Let's say you owe your helper $200 for work done this month, but haven't paid them yet. You're recording an expense you incurred but haven't paid for yet. The journal entry is a debit to wages expense for $200 to show the cost of labor this month, and a credit to wages payable for $200 to record the debt you now owe. This ensures you match the expense to the period it happened in, even if payment is later. Next, let's take a look at accrued revenues. When your company earns income but hasn't received the cash yet, this is accrued revenue. You still need to record it. For example, you catered a party and earned $150, but the customer will pay you next week. The journal entry is debit accounts receivable $150. This shows the customer now owes you this money, an asset. Credit service revenue $150. This recognizes the income you've earned, revenue. You're simply recording income when it's earned, not when it's paid. Next, let's take a look at depreciation. You bought a juicer for $600 with a 3-year life. That's a depreciable asset. Let's say straight-line depreciation is $200 per year. At month end, record 1 month's depreciation. Using straight-line depreciation, the juicer loses $200 of value each year. To record this monthly, we divide the annual depreciation by 12, which is $16.67. The journal entry to record 1 month's depreciation is debit depreciation expense, $16.67. This increases your expenses for the month on your income statement, reflecting the portion of the juicer's cost used up. Credit accumulated depreciation, equipment $16.67. This is a contra asset account that reduces the book value of the juicer on your balance sheet over time. It shows how much of the asset's original cost has been expensed to date. Essentially, you're spreading the juicer's $600 cost over its useful life, recognizing a little bit of that cost as an expense each month it's in use. To recap, here's a summary of all the adjusting entries we covered. Adjusting entries help align your books with reality. They're the final cleanup before preparing financial statements. If this helped you, give it a thumbs up, subscribe for more simplified accounting lessons. See you in the next video.